Let's do it.
All right, I'm gonna let everybody in. All right. Good morning, everybody. We're it's early for me because I'm in Arizona. You guys are 2 hours ahead and 3 hours ahead, so that's good.
What's going on, everyone?
We're gonna let everybody hop in here for a couple minutes, or not even.
Yep. Been a crazy last couple weeks.
Yeah, it has a lot going on. We switched up our office hours live today. We don't want to miss. We try not to miss a week if we can help it. We did last week. Actually, Nick and I were in Tampa when we showed up to our event, and the storm chaser truck from Fox News is at your hotel at the Grand Hyatt. Is that a good sign or a bad sign? I'm not sure. But we found that it is, because they made us leave. So Nick and I took the last flight out of Tampa before the hurricane came through, which ended up rerouting. So that was, I guess, good for Tampa, but not for others.
Yeah. Most of the people left Tampa and went to Orlando, and Orlando got hit harder than Tampa.
So, yeah. So
what are you gonna do?
Yeah, so that was that Nick and I we do an event there twice a year, and we had some awesome things scheduled, and then the hotel said you guys have to, they literally kicked us out of the hotel, so we couldn't stay anymore.
Then they shut down the airport.
Then they shut down the airport, and it was kind of crazy. And I had family, because I'm not a huge news watcher. I pretty much stick to my lane and what I'm doing, and I think my mom called me. She's like, hey, you might want to check the news, but there's a hurricane literally dead arrowing on Tampa where you're going. So anywho.
Hey, check your message real quick. Maybe just make sure everything's working.
All right. Yeah. Can everybody hear us? Thumbs up. If you guys have any questions, please put it in the chat. Good. Thank you. And so I'm going to do a little housekeeping here. So Nick and I have been making a few changes to the creative.
Hey, did you check your phone and make sure you got everything? I sent you some agenda stuff, updated agenda. So just make sure you do that.
It updated since the last 5 minutes that we just spoke.
Yes, it did.
Okay.
Breaking news.
The
Feds just raised rates another point. No one will move.
Yeah. So anyway. Agenda, we're making a few changes to the Creative Dealmaker Academy. And so
we're like, what are we at, over 5,000 now?
Well, we have almost 5,000 people in our Facebook group. We have a really good community that we've built. The cash flow, cash now, cash flow, cash later model is going to probably be one of the best strategies in our current environment, I think, for a long time to come. So the question is, what I'm trying to say is, we do these calls on a weekly basis, almost every week. We rarely miss. And part of it is we really want everyone to be a part of the Creative Dealmaker Academy, which is the digital product. So with a digital product, it's a very, we have probably 80 hours worth of videos. We have all of our replays, all of our Zooms, everything kind of organized in there. And it's important that we really want everyone to actually go through it. And so we're going to repackage it and have a monthly continuity with a little bit different group calls. And so what we're doing now is we're kind of grandfathering everyone in. So if you haven't bought the digital product, go and Elvia will put it in the chat. Go do it, get it, and we will take care of it.
Or don't do it.
You
can not do it.
It's fine too. Yeah. So anyway, that's what
Eric cares more about you doing it than I do. You should do it because you understand the value in doing it. Okay. Because we know right now, look, we were just in Tampa. We were with some of the top educators in the real estate space. That room had probably represented, what would you say, 99.9% of all real estate education. I would say pretty close. That was just the people that showed up. There's other people that are there. But guys, every single one of them go, this is a great model. And I'm not saying it's because it's our model, because it is a great model. Because where can you go do right now?
Not only they're telling they want us, they're everyone's coming to us to actually go and teach them to get through the to understand the process and the systems behind what we do. So that's basically
But
it.
there's there's absolutely, look, if you already are doing real estate transactions, and we talk about this is advanced stuff, right? You got to have we make the assumptions that you have some level of real estate experience, either as being a wholesaler, a flipper, a landlord, a lender, a realtor, something that you've done some deals of some type at some point. Because if you are doing one of those strategies, there's absolutely no reason why you should not be doing 3 to 4 times as many deals in the next 6 months than you have done in the last 6 years combined, because that's how many deals are out there. And that's why we're switching over this this more of into a group coaching, because there's certain things that we are not going to talk about unless we know that the people that are in that group have gone and done the things that we deem as being needed to do. For example, going through the digital product and becoming certified with the information you do. Why is that important? Because you have to understand the concept. Otherwise, you end up shooting yourself. And we don't want anybody to get hurt here, right? You got to look at what the downside risk of doing things wrong is. And we want to be able to get you in and get out of the deals with little to no risk and hopefully infinite ROI.
Going back, one of the things that you just said, little to no risk, is that probably one of the most the biggest pains people are going to have right now in our industry. It's like, if we can get in and out of this stuff and create free and clear debt and get paid on it, and most importantly, you guys know, Nick's a little bit harder than I am, but the purpose behind what we do is if we can help 1,000 homeowners create homeownership that aren't able to do that, and you can be that person in your community, and be part of that. We can't do it alone. We want to do it with our community and you guys. So that's it. Hang on one second.
All right, cool. Let's get into, we had a couple deal or no deals, but I think so we were going to go through a couple of deal or no deal analysis, but I think the two that were submitted that we were going to go through today, I don't think either one of them are available. So we're going to get in the Q&A real quick. Okay. And then if you have a deal that you want us to go through live, raise your hand, but make sure that you have the new version of the analyzer filled out and that you're prepared to share your screen and go through it, because you need to be the one driving it. So if you have something, we're going to go through questions and Q&A for about 10 or 15 minutes. Raise your hand, get all your stuff together on your side, and we'll be happy to walk through that. And if not, we'll just go into open forum and general discussions and stuff like that. So with that said, let's get into some of these questions here. Question number 1. Where'd they go? Why are they down here? Oh, I had to open them again. Okay. What? Let's see here. Any suggestions on how to create 2 notes for a property being sold in North Carolina and the interest rates that can be charged in that state? Okay, so number 1, I don't know what the rates are. You have to find that out. I don't know what usury laws are in North Carolina. Number 2, I personally wouldn't do it anyway. That's the role of the transaction coordinating and management company. That's their sole purpose in this model, is for when you submit a deal, they will get those answers for you. Find the right people in your area to do the deal, whether it be the title company, whether it be the underwriters, whether it be the servicers, the attorneys, whatever the case may be. All right. We're not financial advisors. We're not accountants. We're not CPAs. We're not attorneys. We will never recommend it. Even if I did know, I would still tell you to go do it, because I don't want to be held accountable for that.
So real quick,
yeah.
Nick, in regards to the usury laws, so every state has its own rules on what you can charge for interest, if it's mortgages, if it's credit cards, whatever. And so you got to know what that threshold is. I know for a fact, I just recently did one in South Carolina, and there was some rules that were a little different than we do in Arizona and Texas, which they don't have. So it's just what the threshold is on what you can charge.
Well, and there's another part of this, okay, and this is where it gets gray, okay, because you have the federal law that what Dodd-Frank says you can do, which is APOR plus 6.5%. Okay, I don't even know what APOR is right now. That's the role and job of the underwriter. But let's just say, for sake of argument, which is the average prime offer rate. It's like LIBOR or It's a government index that you can go look up. Mortgage brokers and lenders use this to determine that's their basis, right? So with that said, if it, let's just say for sake of argument, it's 5 by rule, or by according to Dodd-Frank and all the and everything that goes with this, it says I can write it up to 6.5% above APOR. Well, 5 plus 6.5 is 11.5. And then if it's a secondary note, like there's underlying debt on it, like a hard money loan, and I create a quote unquote wrap, even if it's for one day, I get the benefit of adding even more points to it if I choose. Okay. So the rate we can charge under Dodd-Frank is much different than maybe some of the state usury laws. So the question is, who takes precedence? And I'm not going to answer that question. You'll need to figure it out yourself, or just go do deals in states that are designed for seller financing. The top 8 or 10 states are very they're top states for very good reasons. Some of them are rate driven, some of them because that's where note holders want to have their notes and stuff like that. So yeah, just, but there again, when it goes, like if it's Texas, I can answer that question. If it's Arizona, I can answer that question. If it's Tennessee, Oklahoma, Florida, I can answer those questions. You get outside those top states, I personally can't answer those questions, but through the transaction coordinating, they can get that answer for you. Okay. That's the whole reason why we put that in place. So you can get those questions answered. If you guys want to go off on a tangent and try to solve this yourself, that's fine too. We're not telling you should do it one way or the other. We just tell you how we do it.
We are the transaction coordination companies that we're involved with that are in our resources, right? Sometimes they change, so it's always important to be up to date on the resources. But
yeah, there's a resource tab.
They're the ones that, rather than go through it one at a time with everyone, we do it one time, and often as the market changes with our transaction coordination groups, so then they can span out and help you guys at a high level.
All right, good. Yeah, good. All right, Andy Charlton asked a question, and I want to clarify this because I want to make sure that nobody else had this same understanding. And it says, I heard of selling future rent payments. Okay, I'm going to stop before I read the next word of this question. We are not landlords, guys. Don't ever ask me a question about how to be a landlord. That's not what we do. We're lien lords. We're banks. Banks do not own properties and have renters. Okay.
No, they do, but not on purpose.
Not on purpose. Not for long, not for a 30-year time. So I'm gonna answer this 2 ways. One, if he is a rent, I don't have an answer for that. If it was my property, I would convert a renter into an owner, and then I would deal as being a bank. You know, that's why landlords are such a great audience for what we do, is because they learn eventually, hopefully. And when I say this, I'm speaking relative to single family homes. Okay. I'm not talking about, it's one thing to have a rental property, like a storage unit or a multifamily or a commercial property. That's different. What we're talking about specifically are single family residences. Okay. Where there are owner occupants in it. Okay. For us, there's no way I would ever be a landlord intentionally for those type of properties. Okay. It's not what the model does.
But Nick and I love our single family home notes that we create note creators, right? And then we take our money from that, and then we might invest, as the market, bears, into
100%.
commercial, into apartment buildings. And that's where you get some tax benefits and write-offs that way. That's my personal model. Cash flows from note creation, which is very, very simple and consistent and predictable. And then the rest of that stuff, I can go and invest in other projects, build houses.
Look, if I was 25 or 30 years old, which I'm not, I may have a different opinion and philosophy on it. But I learned through time that there's a reason why banks are in the banking business. Right. It's all about control, not about owning. And I've said it once, I've said it a million times. If it's good enough for a bank, it's good enough for me, and it should be good enough for most. And that's all. So we're just sharing our own personal experiences on why we do something, you can either agree or not agree with it. So, the rent, we don't do anything with rent. So, but if that was a owner, let's see. Let's just say that was not a renter and it was an owner, or like you were the bank and you had a note. What you could do is then sell a partial, and that's where he was going to, selling partials. And all a partial is selling payments that you are going to be receiving in the form of the cash flow, and selling them for a lump sum of cash for a certain period of time for a certain rate in a certain price. And then whatever's remainder on that would come back to you. Okay. And we talked about, if you go into the deal analyzer and you watch the video, that 30-minute video that we go deep dive into the actual how to use it. When we get towards the end of it, it talks about just that, on what partialing is, how you can use it to turn the deal into a cash positive on the front side of the transaction. And the next time we do an actual deal, maybe we'll do one today, we can look at it. So, and you can sell a little partial, you can sell a big partial, and it's just a negotiation, right? It's not hard set, it's not hard fast. It's no different than when we buy a first lien position from you guys. Why can't it's not all the same, because there's a lot of factors that go into the value or the risk. What's the yield? Where's the property located? What's the borrower underwriting look like? Are you servicing the note? Are there taxes and insurance escrowed? All these things have a direct impact on the value of the note. And the other side of it, which is hard to really calculate, is a lot of it's subjective, right? Different note investors will say, I don't like the fact that taxes and insurance are escrowed, 5-point deduction. Other guys might go, oh, it's not that big of a deal, right? Or because, like, let's take a servicing for a second. This is what you guys have to understand, and why when we talk about doing the 4 things, there's 4 things we need you to do: find the property, analyze the deal, figure out how to fund it, and then find the owner finance buyer. Once you do those 4 things, that transaction goes to the transaction coordinator. And the reason being is because we can manage on your behalf all those things that we just talked about. Because, for example, servicing is a fixed cost. Okay, let's just say, for argument's sake, servicing is $30. Okay, well, $30 doesn't seem like a big deal, but let's say it's 30, but it costs the same amount of money to service a $50,000 note as it does a $500,000 note. Okay, so if you have a $50,000 note, Eric, what's $50,000 at 10% on 30 years? 420, something like that. 430.
Yeah, I think it's like 438.
Get whatever it is.
Why do I know that?
I don't know, because you have a
I
lot of
don't
them.
know, because I like it.
My point is, in that situation,
438.79.
I was close.
How do I know this?
I don't even need a calculator anymore.
Because I love the 430. I love the 438s that come in every month. That's why I like it so much.
But I'm just winging this here. $30 on 438 is about what, 8% of the total cost of the coming in. So when you have to take, if you don't have that escrowed, and now you got to take $30 of your 430, that's significant, right? But if you have a $500,000 property, add a 0 to it, right? Now you're getting 40, whatever the number is, 4,000. You can maybe absorb it. So, but what I'm going at is, that a note buyer, it affects the yield. When you affect the yield, it changes the discount. When you change the discount, it changes what somebody's going to pay for the note. And here's where the killer is of it. You're giving that away forever, and you lose the ability to have the back end of it and the amortization, because it's like, could be 3x. I mean, if you change it on the front side, and that's why you got to go to the modeling, it's a huge financial difference. That's why we don't let you do it, because you'll crush yourself. Anyway, enough on that. So partialing is something that we can help with on the modeling. It's in there. All right, next question. It says, question, on the first of 4 things needed, find a deal. You say that they're all over the place. Please explain what type of deal best fits into the CDM model. All right, well, in the digital product, we have a whole module on finding deals. And finding deals has not changed. What changes is maybe the rate, what you can pay for it. But here's what I'll tell you about finding deals right now. And this is why, and we don't get into that a lot because that's not what we do. We teach you how to be a bank, stay in the deal, little risk. But I will talk about fundamentally finding deals. 3 months ago, in any given market, a wholesaler who's direct to seller, just like a realtor is direct to seller, let's just say for sake of argument, they were offering 80% of value less repairs. Okay. 80 cents on the dollar less repairs. Fast forward to today, that number continues to go down and down and down and down. So now a wholesaler is
I heard a statistic in Arizona, and just in Phoenix alone, in Maricopa County, it's dropping at 2.5% a month.
That's 30% a year. It's a big number. Okay. But if now because the pendulum has shifted and now you have more buyers than sellers, and you understand supply and demand, we talk about supply and demand all the time, is that now you have a plethora of buyers, and you have more sellers than buyers, right? It's shifted from being into a buyer's market, and now there's all these sellers and there's not enough buyers, right? It's the opposite. Sellers controlled the hammer 2 months ago. They can sell it whoever they want. They could get cash. They get over asking. That's no longer the case. So wholesalers have to negotiate at a lower and lower price because the buyers aren't paying as much. Why are traditional buyers not paying as much? They're not paying as much because interest rates are up. Inflation's up. The cost of ownership is up.
But hey, Nick, so this is what's happening for us personally is our wholesalers, direct to seller businesses, that they're strictly transactional. Okay. They got big businesses, they got cold callers, they've got all the VAs, they're getting leads, they're going to direct to seller and they're getting offers, right? Nick, how many of those wholesalers that were in business 10 years ago that are in business today are blowing your phone up right now?
I try to call my phone right now, and I finally got my voicemail to 100% full.
Yeah.
Finally.
Yeah,
so now they can't even leave me a message anymore.
No, my point is.
No, let me finish because I'm going to where it's at.
Okay.
Thank goodness it's full because I would not be able to have conversation with them. But what's cool about it now is that we can take wholesalers and teach them how to do 3 to 4 times more deals. Because
this is the point of going through the academy, you're gonna know.
Let me finish where I'm going this, and you can. I know exactly what you're saying. Okay. Think of it this way: if wholesalers are at 80% and now they're at 65% on the negotiating, that's 15% less than what they were doing before. But guess what hasn't changed? What I buy at, I don't need to change. My buyers aren't. When I say my buyers, seller finance buyers, were never affected by a 2% Bank of America freaking interest rate. They never were because they couldn't get it anyway. So if we've been writing mortgage notes at 10% interest for the last 12 years and rates were as low as 2.5 or 3, and we were still doing it, how hard do you think it is to me to write it now when rates are over 7?
Yeah.
Some squirrel running by the window out here. That's not my neighbor. You see what I'm saying? So that's why there's more opportunity. Okay. Buyers are still there. They always have been. They always will. There will always be a huge demand for buyers that need seller financing.
The 70% of the market that rent because they have to rent is still there, and it's probably increasing. And the other 5% of houses that are listed, which is less than that, we just use as a round number, that are listed for sale on terms, are there. So supply and demand. That's what I'm saying.
Wholesalers have the ability to go.
If you go through the academy, you are going to know 99% more than any wholesaler out there, and you could be their consultant to just literally hand you deals on a platter. And guess what? Nick and I were doing this the other day. I'm a deal guy. I want to do a deal. If a deal comes to me and I feel like I can make it done, I'm going to do whatever it takes to back into it. But what I caught myself doing this week was trying to make a deal fit when I was like, what are we doing? Make the offer exactly the way you want it to fit, and either it either works or it doesn't, because The deals are going to be coming. They're going to be so plentiful with the exit strategy that we talk about, that the opportunity, the deals are just going to get better. Your cash flow is going to go up tremendously by the opportunities that come.
Well, and I want to finish on finding deals, because this is the because of the dynamic shift in the market in the last 60 days has put us to where we're getting ready to go to starting in November, because finding deals will be part of what we do, but moving into the next segment that we're launching. But
what do you want to call that? That's the Creative Deal Maker 2.0.
Yeah, but I cannot have a conversation on. I'm thinking of this, and I don't want to get into the exact deal. Maybe we will later. This deal that you and I were just looking at over in West Phoenix. Okay, and we're looking at, and we have a motivated seller, and we're getting ready to do this crazy deal structure on creating a first and a second, having them subordinate and be in the second lien position, stay in the deal and let us do a payment back to him, get him some cash that he needs. My point is, we can't do those kind of analysis and deals if you haven't gone through the digital product and have become certified and done it, because it's hard enough to understand what we do now. And when I start really turning up the heat and you start getting into stuff and go, well, you're going to do what? You're going to subordinate this? You're going to do a substitution of collateral? You're going to go offer them at 50 cents on the dollar in 2 years, the 1st of December, because it's Christmas and taxes are due. Yeah, all of that. But I can't even have an intelligent conversation. I mean, we're working with some of the brightest people in the world. And look, my biggest fault or challenge is being able to get from here out to here for you guys to understand and comprehend what it is I talk about. So even doing the certification is just a small part of what we need to get done. But I'm telling you right now, if you trust what we do and what we say, the number of deals that you can get and what's going to become available as a result of the market conditions right now. Look, there was 8 million forbearances that got lifted in March. 8 million. That means there's 8 million people out there that had mortgage notes that because of COVID have been, whatever, deferring, kicking the can down the road, whatever you want to call it. And now, there's Judgment Day. And banks are not going to wait forever to get paid. They'll do everything they can to work with you, but all those 8 million, unfortunately, all those 8 million are not going to come out unscathed. And there's a huge opportunity for us to come in and solve these challenges that people have. And it's going to take a lot more creativity, because you're going to have an equity position. Guys talk about teach sub 2 all the time. They don't teach and they teach you how to gap fund the deal. But when you have a gap funder, now you got twice the risk, because you got a risk to whoever lent you the money for the gap and the underlying mortgage. All right, good luck with that, unless you have a very defined strategy to exit out. And
is it possible that you wake up a year from now or 2 years from now, and the gap funder that you brought into the deal potentially has no more equity, and now you're in a problem?
Yeah, I mean, if you're sophisticated enough, or you're capable to write a non-recourse loan or something like that, and I'm not saying people are going to go out and commit a fraud. I'm not saying that at all. But shit happens, right? Values go down. We talked about what happened in 2008. The difference between 2008 and today is there's a crap ton of equity in these deals now, right? Big difference. Okay, banks screwed up the first time. They over leveraged everything. They gave you 125% of true value. They had arms. And when you owe 50% more than what it's worth, the motivation level to fix that problem as a borrower is just not very high. Today, there's a lot of motivation as a borrower, because the house is worth 300, you owe 200, but you got this $100,000 of debt equity that's locked up, and you can't do anything with it unless you have the bill, you have to sell it. There's no other way around, because very few people, if you're in a default situation, are going to let you do anything. I mean, you may get the bank to do some kind of loan mod or something like that, but there's no guarantee because they may want to re-underwrite you and see what the risk is. So anyway, enough on that. I just wanted to say these are the kind of things. I don't know, maybe we'll talk about, if no one has a deal, we'll talk about some of the cool stuff we're looking at doing on that one. We don't know if we'll get the seller to say yes, but he's pretty damn motivated. All right. If I say, for example, going back to the CDN, for example, a flip and a buy and hold hedge fund and an buyer all have different opinions of the deal. So I don't know what that means, but while this is what the exit, this is the best way to look at this, guys. The exit, the exit, the thing that we're going to exit out of does not change. Okay. And the exit, the final step in the process is always the same. It's creating a first and a second lien, writing it such that we can sell the first lien to pay off the underlying debt and stay in the deal in some capacity at some value in perpetuity for as long as that borrower is making payments. Okay, until they pay it off, refinance it, sell it, whatever. Okay. There's other things that you can do, but I'm just saying that's how we model it. There's nothing wrong with staying in an arbitrage in it, but I'm telling you right now, that's not the model that we're going to talk about in here because it's a risk. Because one of the questions was, does anybody got anything regarding hypothecation? Okay. So what hypothecation is think of it this way. If you buy a house and you do the Burr method, right? And you go out and you get a loan against the house, right? You get a bank loan for the house and then you're getting cash flow from your tenant. Let's call it $2,000 a month and you owe Bank of America $1,500, $2,000 in, $1,500 out, $500 a month gross cash flow. Pretty easy to understand. And that's what most people get. Well, hypothecation is the same, is very similar. And what I mean by that is you don't own the property anymore. So you're not borrowing against the property. What you're doing is you're taking the note that you wrote, okay, and you're borrowing against the note, okay. So it's sort of like a partial in a way,
but Nick, so if you, let's say it's $100,000 note, $100,000 loan, you borrow it at 7 and lend it out at 10. But
you're only going to be able to borrow. You're only going to be able to borrow. Banks are changing the rules all the time. You know, a year ago, you might have been able to borrow 70% at 5%. So $100,000 note, you could borrow 70 against it.
No, that's not what and maybe you're having a different idea on hypothecation. I can go have a first mortgage at $100,000. That's the mortgage that we created. And I borrow $100,000 from a private investor, pay them 7.
That's not, that might be true, but I'm not talking about
that's
hypothecation is usually done at a bank level. It's a bank thing. So you can get somebody to give you 120% if you wanted to. You can negotiate it. I'm just telling you what most banks in a year ago, you could borrow only 70%. Just like hard money lenders don't give you more than a certain amount, right?
But no, I think what I'm trying to say is the loan is already at 70%.
I'm telling you right now,
the mortgage
is not what happens in hypothecation.
Okay.
On the bank side. That's not how they look at it. They don't give two rips about it. In fact, I had a conversation with them, and a guy wanted them. That's exactly what he wanted to do. And I'm talking to this 25-year-old banker. Okay. And apparently they know more than I do. Okay. And maybe they do. And I go, so let me ask you a question. The property is worth 100. The first lien position is $75,000. Okay. How much are you going to lend on that $75,000 first lien position? We will lend up to 70% of that value at 5%. Okay. And I go, how do you get more than that? I go, and he goes, well, it's all based on the. I go, what if
So Nick, they're going to lend you 75. They're going to lend you 75,000. They're going to lend you $75,000, and you're going to pay 5%, and you're going to lend it out at 10.
And you're going to arbitrage it. Yes,
that's what I'm saying.
Yes.
So, but what I'm saying is
you're not going to get 100%. Not at the bank.
Hold on. So what I'm saying is that is a great strategy. But right now, if I believe now you're responsible.
Why is that
for
a
the
great
debt.
strategy? Explain to me why it's a great strategy.
Because you're borrowing at 5 and lending at 10. That's a great strategy. But there's risk. Now there's
Well,
risk.
so
Now
how
you're
great is
responsible.
that's exactly the point. Well, shit,
Yeah.
dude, you can go invest in gold and diamond mines in Colombia for a 72% return on your investment if you get paid,
Mhm.
right? There's risk.
So what
there's
I'm saying
uncertainty.
is now I like hypothecation in certain environments and if you have the liquidity to handle a default, but you can create a hypothecation. You can do a hypothecation and write the paper according to where if that borrower doesn't pay, you don't have to pay. You can do it with zero risk.
You can
it
do
that way.
anything. Okay. You can get
Mhm.
somebody to lend you $200,000 on $100,000 transaction. Is that correct? You can get anybody to do anything. That's not the point of this. The point is it the right thing to do? Right? Is it the best thing to do?
It's based off market and your risk threshold. That's all.
All about tolerance for risk.
Yep.
And me personally, I don't want any risk or liability at all.
That's why
I really just do
your risk
a little
and
less and get more
your risk
deals
and
done.
my risk might be different at that time period.
Well, that's why you always got to ask.
If I inherit $50 million and I want to hypothecate all of your loans at 5%, I might do it because I trust that you created a nice note.
Well, and that might not.
And
be
then I
risky.
create a deal where if they don't pay, you don't have to pay me. And then I create this person.
Yeah.
Now you have no risk.
Right. But I can tell you this:
out there.
if I have no cost basis and I have infinite risk, there is no argument because you can't dispute infinite ROI.
Right. All right.
But I can just, but you can
subjectively
decide.
We'll do a separate segment on hypothecation and detail on exactly.
Yeah, I'm not a fan of it personally. I'm not a fan because there's risk. I mean, hypothecation is no different than really doing a sub-2 deal.
I know it's a Burr model. It's the Burr model. It's the Burr model for notes. I get it.
Yeah. So.
And now rates have gone up, so it's harder to make the math work. Yeah. It'll get better because we're just going to be our wholesalers, our fix and flippers, and us going direct to seller. We're getting better deals anyway, so the math's still fine.
You don't need it. I'm saying you do not need to do it, and if you do choose to do it, that's fine. Nothing wrong with doing it. We're just not going to really get deep in this kind of call. Do it because our whole objective is to try to create as many deals with little to no risk and infinite ROI, period. That's the box that I'm trying to fit everything in. And if you decide, you know what, I'm okay with that because I can write a check for $100,000. You know, the biggest challenge that I hear from people that do hypothecation, okay? All right. So like Mitch Stevens and Mike Powell in San Antonio, they've been doing seller financing for years. They've done more deals than I have. They hypothecate. But I had a conversation with them and I go, how's the hypothecation going? He goes, well, conceptually it's great, but in reality it sucks because I have too much paper now and I can't.
But they also borrow short and lend long, and I don't agree with that.
Well, but my point is that you generate enough paper, you know, look, at some point a bank's not going to want to have anything because they have too much leverage out in one thing. That 70% gets to 60 to 50. At some point, they say, I don't want to lend you even 5 cents on the dollar because you have 90% of my money that I can afford to lend out.
We get it. I'm moderating. Let's go to the next question. We got it.
You don't
go on this for hours. Let's start adding value to the
important because it's all about risk. It's one of the most important things because it's about risk. Just like when people ask about sub-2 deals, it's about risk. When they ask about Airbnb, that's risk. Okay. Everything's risk. We don't want to have risk. I don't want to have risk. All right. Next question is, where's the best place to get a purchase agreement that is used for sale of the note to the note buyer between the seller of the note and the potential buyer? Well, it's usually going to come from most of the time, the note buyer is probably going to want to utilize their own stuff. Not always. If they're not sophisticated, they may not know.
If you're creating a note buyer if you're going to go create your own note buyers, you're going to create your own purchase and sale agreement of the note and sell them the note that way. So we
But
have,
if you come in through our side of it on USA No Pro, we're buying it. We're gonna have the
we're
purchase
gonna
sales
write the
agreement.
offer for the notes that we buy.
Yeah, the purchase sales agreement, the launch, the collateral assignments, all that stuff. And it's all in the digital class and the digital stuff too. All the stuff's there. You can use any of that stuff for a reference.
I think where Nick's going, I mean, the purchase and sale agreement for a note, all that is very simple templates. It's there. We typically don't give away. Well, it's all the stuff's in the academy, so you can go model it any way you want. But when you start giving people contracts and stuff, and they're saying that we try to stay kind of neutral.
I don't give anybody anything.
Yeah.
I wouldn't give anybody I would never take somebody's purchase sales agreement, even if I say it's mine and I say, here it is. You should never use that, because one little word that's not correctly identified. Here's the problem that most people don't understand. Okay. When you have an attorney create your documents, I don't care if they're lender documents, closing documents, purchase sales agreement documents. Okay. When you have an attorney do it, they're doing it most of the time, they're doing it from a legal perspective. Okay. Make sure that it's legally structured correctly. I don't want them to do it from a legal perspective as the only option. They need to be doing it from a lender perspective. Okay. They need to be doing it from the lender, from a bank's perspective. That's why banks write their own damn documents, because they want it to say exactly what they want it to say, not what somebody else wants it to say. And if you don't like it, then it's not a deal. So all of our documents that we always use, and that they're in the vault and stuff, they're all written as with the bank in mind, the lender in mind. Okay. They obviously are legal too. So, let's see here. I need an insurance company that would cover my borrower and home mortgage. I don't know if we have anybody in the resources, but there again, this is Svetlana. We know her. I don't know if she's on the call or not, but guys, 4 things to do. And I'm reading these questions because I'm hearing a lot of things that aren't the 4 things that we're trying to get you guys to do. Find the deal, analyze the deal, fund the deal, find the buyer. Does it say, how do I find my insurance in any one of those? I don't think so.
So when you're doing your transaction coordinator can help with that.
Yes, that's my point. Okay. I'm bringing it up because, guys, you don't have to worry about that. We'll get you the right insurance depending on what the deal is, because each deal is different. So if it's a sub 2 wrap, it's one thing. What if it's FHA? What if it's seller financing? What if it's a hybrid? What if it's in a judicial state or a non-judicial state? I mean, I could spin off 50 different things that'll affect the answer to that question. Don't know. We don't know until we get that package in and we send it through the coordinating process. This is where most people screw this up. Okay. The seller carry market is almost $30 billion. Okay. And I'm going to tell you right now, of that $30 billion of seller finance notes that are created, which is what we are doing right here, well over 90% of them are not accurate. They're not done correctly. There's scratches and dents. There's missing components of it to be premium paper that wants it, that a Fortune 500 company, a hedge fund, a family office, a bank, financial institution would want to buy, because that's what they want to buy. They don't want to buy a bunch of non-performing or scratch and dent stuff. But if that's all that's available, that's why we do this. Okay. Because otherwise, when you do that the incorrect way, it costs you. The note still has value. Okay. The question is, what is the value? You have a brand new car. I don't care if it's brand new. If you go wreck it an hour after you buy it, is it worth as much as it was before you wrecked it? It's still a brand new car. See, that's what we're trying to avoid you guys from doing, is wrecking the car and putting stuff on it that has to be fixed. Because when you have to fix something, it costs money. Anything you want to add on that, Eric?
Well, yeah, I mean, that's what we teach. That's what we teach in the systems that we put into place. So where we're not, when we create the note from scratch, there should be no scratch and dents. Now, obviously the borrower might not pay and all that stuff, but
well, no, but
set it up correctly.
But that's after the fact.
Yeah.
Right. At the time of execution and the time of creating and of the note sale, it is a, for all intents and purposes, a perfectly written stack file.
Yeah,
It's every bit as good as anything.
So one of the things, so Caitlin put in the chat here, I feel like risk is unavoidable. You just have to know how to manage your risk with evaluation of ROI recurring to make decisions moving forward based on information that you're doing now. So what I will, and then I'll let Nick respond to this, but when you create a free and clear second lien, and you have no cost at that point other than your time to create it, and you don't owe anyone any money, and it was underwritten and closed properly. The only risk is if the borrower doesn't pay, the market crashes and your note's not worth anything anymore.
Let me rephrase.
But I'm going to give you a true story with me, is I had that happen 11 years ago. And what happened? The borrower stopped paying, but then the house declined below what my second lien was worth, and it went into a deferred payment model. And I just waited, and they didn't move because they didn't have an affordable place to go. They kept making their payment. And 11 years later, my $30,000 lien was worth $72,000 with deferred payments. And they went to go refinance their house that they'd been paying on for 11 years. Prior to that, they were paying for 7 or 8 years. So they had a massive amount of amortization pay down for their existing loan, because it was a sub-2 deal that I did 10 years ago. Anyway, long story short is I just waited. And so now I had a windfall of $72,000 because guess what happened to their house? It doubled.
Was that free and clear?
No, it was a sub-2 on it. No, I had no risk on it because I didn't owe anyone anything on that 30,000.
So there was no underlying mortgage at all?
Well, there was a sub-2 loan that I took into place, but they kept paying that.
Oh, so they could have maybe stopped paying that too, right?
They could have, and I could have, yes, but they didn't. And so over 11 years, my interest accumulated. But the best thing for them was they didn't have to move. They couldn't afford it, whatever. They wrote it out. 11 years later, they can't afford it, and their house tripled in value. So they owed 100 and I'm just gonna use round numbers. I think with my 72,000 in the pay down, I think they owed about 175, and their house went up to almost $400,000. And so they had a short memory because they forgot that they had a lien with me that accumulated to what it did, but it was a win-win for them because I still got my money. So that's one.
It turned out to be that way. But there was a lot of things that could have gone wrong that could have really been expensive, right? It worked out, fortunately, which is great. What I'm saying is this, Eric, here is a $10,000 mortgage because you're a great guy. I'm just going to give it to you. The buyer's going to pay you, he's going to pay you $100 a month for 30 years. Okay. And the buyer pays you, and they pay you. And then 3 years from now, they stop paying you. What's your risk? I gave it to you. Cost you anything. What's your risk?
I'm the bank. So the only
what's the risk? What is the risk? If I give you something and you get something back and somebody stops paying you, what is your risk?
I'm just not getting paid. I don't owe anyone anything. I don't own the house.
Yes, exactly. You don't owe anybody anything. There is no risk.
Yeah.
You can say,
when you create it, you have risk because you took the time to create it, and maybe you could have flipped it or whatever, but you did have some income coming in. But when it comes to liability, like the Burr method they talk about, you're on the hook for that debt. You owe the money. If the renter pays you, it doesn't pay you.
You own a free and clear note. You have no financial liability.
That's correct. Yes.
Period. So if the borrower stops paying, so what?
Yeah.
So what? You still have the value of the note,
and it's leaning the property.
You may get paid for it at some point in the future. I don't know. You can go, hey, if you want to be that into the deal, go foreclose from the second lien position and go chase your money down.
Yeah.
Or just go do another deal. Yeah. My point is that there's no financial risk or liability as a result of structuring that way. Can you make more money doing it another way? Absolutely.
I will tell you, if you had 10 free and clear second liens and there is a default, guess who's going to find out first? You, because you're not getting paid. So now you have an opportunity to create another opportunity with that deal because of their financial situation. Maybe you can help them out. Maybe, there's a lot of things that can happen. The best part I love about our model is if there is a default, it's either short-term or long-term. So maybe you work something out and do some sort of a modification, loan modification or whatever, and get them back on track. Okay. The second thing is if it's long-term, and I've said this before, one of our other calls is I sold a house on seller financing. It was a sister, brother, sister-in-law. Sister, they put 28,000 down. It was a great deal, great cash flow. Everything was wonderful. But sister-in-law and brother went to prison forever. I mean, they did something really horrible. So the sister could not make the payment anymore. That was a long-term problem. So what did I do? I knew, because she was trying to put her head in the sand. I found out very quickly because she went in default, and she paid for like a year and a half and then had a problem. So we just fixed it. I said, hey, where do you need to go? How much can you afford? She sold the house back to me. I gave her I actually gave her almost all of her down payment back and helped her find another place. Okay. I didn't have to do that. I just had systems to do it. And then I went and sold it for more money with a larger down payment. So it was a win-win for everyone. And that's the benefit for that. That's what we do. So I helped her go put herself in a better financial position. I gave her some cash, and then I went and sold to another family, because here's a benefit. We already have the buyers. We don't know who they are, but they're out there for this specific type of property that we're selling to. So that was a huge win for us. I helped her, and I still was able to make a few bucks. And
they have notaries in prison.
What?
They have their own. Do prisons have notaries on site?
They actually do.
Do they? Yes. I would think you would. I say that funnily, but I'm thinking I bet you most of them do, because there's a lot of legal stuff that they probably have to sign.
I sold a house. I bought a house from a guy, and he went in. I don't want to go on a tangent here. The short story was, he goes, it's amazing when you're in prison for 7 years how good your credit is. He came out of prison and got an FHA loan for this house. And then so the problem is he bought a house in an area he had to go back to where his parole officer told him to move back to. Point is, I still got the deal, and so anyway, prison isn't that bad, I guess.
Last question, and we'll open it up. So this was in Dream Baltimore says, I have a sub-2 deal. The buyer's asking 121, which is their equity. The remaining balance 210 on terms. I'm not able to do the deal this time. Anybody interested? Well, yeah, I'm not sure why they didn't send it to us. I mean, I'll buy it. You got Jackson or John, you need to go find them and let's go you'll get the mortgage statement. Let's see if we can do the deal. We'll bring it in and we'll do it for the group and see if how we would structure it. But Houston's a good market, it's a good price point. Absolutely. We can structure the deal. And
if you guys have deals, just send it to support@creativedealmaker.com and we'll take a look at it too. We have another system that we're setting up to input our
actually
deals.
I don't think that's I don't know if that's the right email address. Elvia, what do we do for, what is our protocol? It's in the is there a different email? It's in the resources. It's in our submission where it talks about how to submit.
Put it in the chat just in case.
Put it in there.
Yeah, I will.
I don't think it's support, but either way, we'll get it. So
if it gets a support, it'll get where it needs to go. But so I have one for Super Susan, because she always has the best questions
Susan.
ever.
Hey, Susan.
So it's in the chat here. So if you're going to hold both notes, how can you do a first and second with someone who is a bookkeeper, gets paid in cash a lot, but only shows low income on past 2 years of tax returns, has only 540 credit score? She says because of a high student loans, but can pay over $1,700 a month because she pays her mom's rent and wants to own instead of renting.
Okay.
That's our buyer, right?
It's not for us to decide. Goes to the transit. 4 things. I'm going to keep saying it over again. Find the deal. It sounds like she found it.
Yep.
She analyzed the deal. She thinks it's a good deal.
Mm-hmm.
She's obviously, she probably has a way to fund it otherwise. And she already found the buyer. Okay. She already found the buyer. So my first question is, what did the RMLO say? What did your RMLO tell you?
Hey, stop yelling at Susan. She's my favorite.
I know, I love Susan. My point is, what did the RMLO? My first question is, well, what did the RMLO say? Why are you asking Nick and Eric?
She won't pass the RMLO.
Oh, well then.
Well, first of all, she's not the lender. Okay. There's one thing that you have to do under Dodd-Frank, and I would fire my RMLO and go get another one if they don't understand this. There's one thing and one thing only, as long as you're a small cap lender. You have to prove the financial capacity of that borrower to make the payment. That is it. Everything else is for consideration. You have to look at credit score. You have to take an application, you have to do all that stuff, but it's not a condition of us underwriting. I can approve a borrower with an 82% DTI if I wanted to. Nothing says I can't. Would I do it? Probably not, because guess what's going to happen? When I go to sell that note and I put my note buyer hat on, it's going to have higher risk. Would you agree? If I wrote somebody
Yes.
at an 82%, okay, well, what's going to happen when you have higher risk? You gotta sell it at a bigger discount. So then it prevents the deal from working at that point. Doesn't mean
So
you
real
can't
quick,
do it.
Susan, you're saying, because you're gonna hold the first and second, you just, this is your deal, but this is what Nick and I will always say. And I do the same thing, because I hold notes myself too, because I like the returns and I like the cash flow. I don't always sell everything. And Nick and I don't always sell everything. But what I will say is always create paper to sell, because you don't know if you do want to sell. You don't know what their circumstances are. So if this borrower doesn't fit all the criteria for the underwriter and you, and then but you still feel, oh yeah, I still want to sell this house to that person, there's a risk for you to sell that note at a discount because of the way it was underwritten and the qualifications of that borrower and their ability to pay. Would you agree?
Yes.
Okay.
Well,
Yes.
there's two things
really
that
up to you as the bank.
well, there's two other things that you can do to remedy this, right? You can put that borrower in a much lower loan to value, okay? Get a higher down payment, lower loan to value. Because if this is a 50% loan to value, it's a big difference on what they are underwriting as if they were at 90% loan to value.
Because you say she's gonna put, I think you said, Susan, that she's gonna put 15% down.
Yes.
Well, but I'm saying you might
And
have,
then based
I'm not
off,
saying
and then
you
based
can or
off your
can't do it.
cost basis, and maybe they're have a higher risk, maybe create the first and second, maybe create the first at 60% and the second at the
at a
difference.
higher back. So if you do
So,
need to exit, that's number
so if
one.
you want to have a higher, if you do want to sell the first lien and get more of your liquidity back, if you need it in the future, then you have the ability to do that. So rather than do a 70, what is it, 70-15? Is that right? Yeah, 70-15. You might do a 60, whatever the difference is on that. I'm losing my mind.
Well, here's
Yeah.
the other thing, Susan. These are brand new notes, okay? So when you have a new note, you don't have payment history, okay? So some
Correct.
assumptions are being made. But once there's payment history, that takes precedence over most of the other stuff. Because the preferred thing that most note investors want to see what the payment history is. Right, wrong, or
Yes.
indifferent. I'm not saying it's the first thing I look at, but it's what a lot of people are taught to do. How long has it been performing? Is the buyer habitually on time, habitually late? So those are things that buy that back end of the side of it. So
I'm just reading into this borrower. It says she gets paid a lot of cash. Okay. Sounds to me like, and I don't want to say, I don't want to profile, but landscaper, pool guy, self-employed family. They're working, housekeeper. Like
Yes,
they get
bookkeeper.
paid. They will make the, I'm feeling like this borrower will make the payment based off what you're saying. Their credit is at what it is, but there's still an ability to dig deeper in where they're getting paid. You're not the IRS. All you want to do is make sure that if they're like, yes, Susan, I get paid $5,000 a month in cash from 7 different people for doing X, Y, and Z, and here's what I do, and you can document that, and then they come back to you 12 months from now and go, hey, Susan didn't qualify me correctly, and I want all my money back plus interest because
okay,
I didn't
stop right
check the
there.
box.
Stop right there. We're going to confuse everybody. Susan's not going to do any of that.
Right.
Okay. Don't use the word Susan.
Right.
Use the word RMLO. That's
Yes.
what they do.
Yes.
Susan's job is to oversee it and approve
Yes.
the final thing. Okay. So let's not confuse it because you're not going to take the application from the borrower. You're not going to pull the borrower's credit. You're not going to verify and do a verification of employment, a VOE. You're not going to verify bank statements. That's not what you could do. That's what the RMLO.
They have it. That's why you outsource all this stuff so you don't screw it up. Now, but look at this deal. Take out all the stuff that you just said and has only a 540 credit score. Nick, how many deals have you done with this same exact profile with no credit because they're not from the United States?
I bet you 20% of our deals that we've underwritten zero.
There is no 540
not have
credit,
a
but they
credit
get paid a lot of cash and they document it, and that's what
They
the
just don't
that's
have
what
a
the
credit
RMLO
file.
does.
They
This
don't
is
have a
your
credit
this is your buyer. This is the profile of who we sell to, because guess what? They're phenomenal borrowers. They're great payers. They're not going to get traditional bank financing, and guess what? They're probably not going to do move because they have no other place to go, and this is where they're going to have their family and their everyone. So this is the type of profile you just want to make sure they still fit that box. Okay.
Okay,
That-
now, first
I
of
mean,
all,
just because
I
they make cash doesn't mean they don't report it. I want to make sure of that too.
Yes.
A lot of
yeah,
buyers a lot of borrowers get paid in cash, but they report it.
Yeah.
but
You know,
she
it doesn't
does
mean that
not.
you don't.
She
But
does.
again,
she-
it's not
does
for
not.
us to do that. Okay, guys,
Okay.
not our job. Our job is let the underwriter determine the ability that the borrower can financially make that payment. They might have cash deposit. Look, if they got cash in their mattress, then they need to go probably put it in the bank and then verify. But
Yeah.
guys, that's
Okay.
not for us to determine. That's
Yeah.
the role
One
of the
other-
MLO. Okay, that's what
One
they
of-
get paid to do.
Go ahead,
One other
Susan.
caveat, and
Yep.
that is that she has to qualify by the homeowners. And they want
What?
20,
Say again. I didn't
Are you
understand.
you? I think you mean an HOA, homeowners insurance.
correct, an HOA.
Oh,
And
wow.
so the HOA, because it doesn't have any reserves, wants to have a new buyer with 25% down, a 640 credit score. And so we were thinking of putting up 1 year of HOA in escrow. So that means the property is being sold for 88,000. And we think that if we do a cash sale and then put on the mortgage after the cash sale, it will pass the HOA.
That's now if the HOA has and they have CC&R.
Ask me how many. I've done over 1,100 transactions, Eric. Ask me how many of those kind of deals I've done.
0.
Look, Susan, I hear what you're saying.
Okay.
What happens if you just
Wait, no, but real quick, I want to interrupt real quick, because what if Susan purchased that property for $30,000 and she's getting all of the down payment to cover her cost, almost like a car, and she has no risk at that point? Is it worth structuring this deal to create the cash flow she wants? I don't know what your cost basis is.
Whoa,
Practically zero.
Your cost basis is practically zero. Okay, well, then that
here's
changes
like
things.
interesting. What if you just deeded the property to her? I'm not saying you're going to. Then what happens with the HOA? Just curious.
That's why we want it to look like a cash sale, because then they cannot say no, especially if we put up 1 year of escrowed.
You know what else you
payments.
can do? Yeah, I did this
You
on
do it as a contract for deed.
No, they won't allow a contract for deed in the HOA.
so real quick, Susan, I did this. I had an
I just want to do
HOA.
this deal.
Yeah, hold
take
on.
it to
Hold
him.
on. I'm trying to give her a real life scenario here, not. So I had an HOA, I had a solar, lien, taxes, insurance. All of it was escrowed. So the borrower gives me, I'm just using round numbers, 2,000 a month in escrow. The servicer pays everything to the HOA, everything to the solar company, everything to taxes, everything insurance. It's one payment and it gets passed down. The HOA doesn't have any idea what's happening. They just get paid. So that's one way to do it. You can escrow everything and not worry about it.
Got it.
That's a
There's
strategy. I don't know.
so many ways that you could structure this. There really, really is.
But I feel like what you're trying to accomplish is you have a really, really nice borrower, you have a nice down payment, they want to live in this property, and HOA's having some weird restrictions. You sell them the property and then put everything in escrow, and then the servicer pays the HOA, the servicer pays everything, and they get paid, and it's just
So
a check
if I had
box.
a 480 credit score and I filed bankruptcy 4 times, okay? And you deeded me the property, would they let me live in that? Would they let me own that property?
Only if you put up 1 year of HOA in escrow.
There you go,
Okay,
solved.
Got it.
so that seems like that's your answer right there, is the
Mhm.
escrow HOA.
Yeah,
Perfect.
Right.
Close it on,
Okay.
put it on the closing statement, pay it at closing. And
yeah,
Got
it goes right into, you add it to the down payment, or you add it to the price, then take it out of the down payment. You could structure it a couple different ways, but yeah,
yeah, you
that's
did it.
what I would do.
But the thing is that we would have to close with no title insurance. And then when we put the first and second on, we would get a lender's title insurance policy. That would be
Okay.
after she was approved for the HOA.
Okay,
Well, first of all, you are the lender. So if you're gonna hold a note, you don't, you know.
Right.
The LTP, the lender title policy, is really the most important thing when you go to sell the note. But you can always add a lender title policy. You can always add it. Might cost you more money to do it, but you can.
for the listeners and viewers, explain to them why you would want a lender's policy if you are involved in this
Well,
transaction.
before I answer that question, 4 things: find it, analyze it, fund it, sell it. Lender title policy is not one of those 4. Okay, just now I'll answer your question, but it's not one of the 4. Okay. The reason is because it gets back to when you have that package and that stack file, that's part of the collateral file. It's part
It
of the
shows your
risk.
position is secured against that property at the time of the
All
sale.
goes
or
into the
time-
equation.
When the note was
All
created.
goes into the equation when a note buyer is looking at purchasing a note, right? Some people, just like sometimes it's a contract for deed versus a mortgage deed of trust. Some people don't care. A lot of people do. I won't buy a contract for deed unless I have the intention to convert it to a mortgage deed of trust. Now, I say that in relative terms. If I can buy the contract for deed at 20 cents on the dollar, and if it versus 80 cents on the dollar that a mortgage deed of trust, I'll probably buy the contract for deed. I'm talking about like to like. So that's it. It's just structure, and it's all when note buyers are looking at life and they're looking at right, wrong, or indifferent. I'm not saying this is what I do. I'm talking about most note buyers. The number one thing they're probably looking for is yield. Once they know what the yield is, their return, then they look at how much risk there is for the amount of return that they're getting. Obviously, the higher return, the more they may have the desire to take on more risk. Okay. And then from
Thank
there,
you
it's just,
very much. Thank
you
you.
talking to me or are you talking to somebody
Yes.
else?
No, I'm talking to the 2 of you. Thank
Well, I
you.
thought somebody was like leaving, like the FedEx guy just dropped you off of like a cashier's check or something. And you're excited.
She just got her Uber Eats smoothie dropped off to her front door.
So
You guys
anyway,
are
guys,
hysterical.
these
You're
are
terrific.
great, guys. These are great questions. They really are. And my answer is always going to be the same. Is it one of those 4 things? If not, submit the deal, let the transaction coordinator team take it over. We will figure out the answer and get it back to protect you guys from when you create the deal, whether you sell it or not. I don't care. But if you do create notes, create them with best business practices in mind. That's it.
That's
How do I know
Nick
that?
talked, when
How
we
do I
talked
know
about
that?
the $30 billion industry, most
30
of them
billion,
are,
$30 billion. That's
did I say
billion.
million?
You did say million.
Sorry,
I said million the
Billion.
other day too.
billion at 30 billion, but the majority of them aren't created. They're fine, they probably pay and everything, but you always want to have them created. Like I just said before, I have a buddy of mine. He said, hey, what did he have? I thought he had maybe a few $1 million worth of notes. I found out, I think it was 50 million. And just a random guy that I've known, I didn't know he had this portfolio, and he services them himself. He didn't get them underwritten. He pays all the taxes and insurance and does all this stuff. And I'm like, man, for being so successful, like for couple thousand bucks a month, like for the amount of income you're bringing in. I mean, he brings in $250,000 a year just in, or maybe it was a month. I mean, it's ridiculous. It was a big number. And I'm like, and he goes, I just like to do it. I go, great. But if something happens to you and your estate needs to now liquidate these assets, which by the way, I'm number one on the list to buy these notes because they're awesome. But and they're at 50, the numbers are great. But I said there's going to be a discount based off of the way you've been running this little note business and how you created these notes and what you're doing with it. So he appreciated what I said. Now keep in mind he has no cost. He has
he's probably saying, what do you know? I got all the money. That's true. Okay. That's
no, he
fine.
appreciated it because he goes, I will put them in the set that I will put them. I'm moving them over to servicing. I'm recalculating everything, and then I'm putting you on the list to buy them all. So I'm
The
happy.
advantage that we have, the people that have on it, we can create it right from the beginning and not have to go back and fix somebody else's mistake, right? Because it's not a problem until it's a problem. It's not, if you don't have any intention to sell, then you can write this on a napkin and take $100 bills every month for your payment.
Yep.
There's nothing wrong with that. Nothing illegal about doing that. When I say nothing wrong about it, right? You can write it on a napkin and say, hey, pay me in 20s. I don't care. There's nothing illegal about that contract. However, you say, oh, now I don't want $500 a month. I want $50,000 lump sum. And you have it on a napkin and you've been paid $220 bills for the last 5 years. And you don't have anything in that note. When you go sell it, is worth a fraction of what it would be if you would have documented it correctly. So wear your seatbelt. That's the bottom line. Wear your seatbelt.
I got, so Caitlin,
let's unmute her. Let's unmute Caitlin and bring her on and see what she has.
Yeah.
Okay.
Hi, Caitlin.
Hello.
You
Where
are
are you
the
located? Caitlin, where are you?
bookkeeper extraordinaire. We'll probably have you on at another time. So I'm glad you're in the group. This is great. So
Yeah, where
had
are
a
you
question.
located? Where are you
I'm in
located?
North Platte, Nebraska, but I have
I
clients from
love
coast to
North
coast.
Platte, Nebraska. Not many people know where North Platte, Nebraska is, do they?
No, they don't. It's
Some great
it
golf
is
courses up near North Platte. I love going to
Yes,
them.
there are. You are absolutely
Yeah,
right.
how far are you from Valentine? Like an hour?
Yeah.
See, who knows where
Look at
Valentine?
you.
I knew you would know because there's golf courses up there, and I haven't.
Yes. Sand Hills is up in that area, which is Mullins, which is a little over, and then you cross into
Look, some people have
Colorado
been
and
to
you're
North
right
Platte,
by
Greg.
Sterling. You're right by Sterling, which is not that
Sterling.
far, but an hour and a half.
Yeah.
And then you have Dismal Creek that's right there. That's not too far. Anyway, enough of
You're
golf.
such a
I got a
golf
little
nerd.
excited. And she
So
said, "So excited I should know
Caitlin, so
that."
you had a question. I still have a question. How do you consider, because obviously in the bookkeeping and accounting world, how do you consider non-reported cash as the ability to pay? That's a great question. That it's strictly, I'll give you my opinion on it, because there's a lot of our borrowers, your clients, self-employed, they write off everything and show little to no income.
Right.
And so may have good credit, may not even have credit, but they make great money with their jobs and what they do. And so the RMLOs have ways to check. So do they have a cell phone bill? Have they been paying rent? Our tenants, our buyers, okay, have been their tenants because they have to be, not because they want to be. So they might have been paying a rent payment for 15 years. I mean, literally, I'll tell you a recent story was this husband and wife worked at a restaurant together. They had 28,000 down. They've been there for, I swear, I feel like they worked in the same place for 15 years. Pretty quality borrower, I would think, right? And they get paid a lot of cash. They get paid as well. They weren't documented, meaning they were from Mexico, actually. But they were tenants. 2 weeks later, they were homeowners. One of my favorite deals I've ever done, because
Wow.
they're like they're all like this. These are the people that they're hardworking, Americans that just
Look,
aren't able to get traditional bank
I cannot
financing.
tell
But we're
you how
able to
many people-
provide it for them, right? So
Yeah,
going back to
that's-
answer that question is that the Armalos have certain things that they will go and find to show the ability to pay, which is rent, their cell phones, their utilities. They're still living. They're not on the street. Like, they have expenses and they pay their bills. They just might not document. I mean, as a CPA and a book, or I don't know if you're a CPA, but as a bookkeeping service, like, I mean, it's not, well, it's not, I don't even want to say that. Never mind. I was going to say something I shouldn't.
Look,
So,
here's the thing. Look,
does that make
if
sense?
I get a letter from somebody's landlord and says, I've been paying, that Bob Smith has been paying $1,500 a month rent, and it's third party verified, and the payment on the house they're buying is $1,500 a month. Okay, that is literally all that I truly need to do to verify that they have the financial capacity to make the payment. That's it. By rule.
Not
I mean,
considering a low credit score or reporting to the IRS or the debt to income ratio because of that hidden cash, basically.
Look,
Credit
two parts of it.
credit is, in my opinion,
It's not a condition of a loan
it,
approval.
it really doesn't matter to me, because credit could be, what if they got divorced? What if someone, it depends, like, okay,
Medical.
now, if they borrow money and never pay it back ever, and that's why their credit is crappy, we're probably not going to lend to them, because that's their historical. But maybe you
Right.
don't know, maybe they filed bankruptcy. Honestly, people that file bankruptcy, they're not able to get credit, so they're actually not bad borrowers, because they can't go hurt themselves anymore with credit cards and high interest payments. So
Very
lending
true.
them money is
Here's-
actually not a bad thing.
But
A
here's
traditional
the one-
bank, though, you guys are like opposite of, because in a traditional bank, they're like, I don't care that you have cash that you can pay me. I'm not going to lend to you, even though you need it. Like,
Right.
your program, what I love about your program is that you are reaching out to people who need the money, but on paper can't pay it back, but are diligent and they pay their rent, because that's the only thing they can do is rent a home. But my goal is to be able to help more Americans be able to purchase a home, because it is better for your lifestyle and your future than throwing away money renting to somebody. But banks don't allow the normal middle class American to be able to do that. And
Well, you
that
already know
is
what the number
why
is.
you guys are teaching what is necessary here. And I am very excited to be a part of it.
Well, cool.
Yeah.
That, because look, 70% of America can't go down to Bank of America, Chase, Wells Fargo and get a loan, period.
Yes.
I cannot go down to any of those traditional banks and go qualify for a bank loan. And I can have 10 times the amount of cash in the bank to go buy it for cash, and then it will not qualify me, because I don't
Mhm.
fit the buyer's box. Like 70% of America can't. Yeah, I don't have a W-2 job. Okay, well, they don't like that. Okay.
Yep.
I own multiple companies. They don't like that either. I get distributions for pay. They don't like that again. Okay. Does that make me a bad guy or a bad borrower? No, it just doesn't meet their box. So they say when it doesn't fit the box, they kick you out.
But
They
if
don't
you can
have to
show,
get-
if you
they
can
don't
show
have to
the
do
ability to pay consistently over time, that fits our box.
So
And
what
that
is
fits Dodd-Frank.
overtime for you?
Well, I mean,
Can't predict the future, but you can vet them enough to qualify. But here's what people don't realize, okay? The asset, the house, is the security for
Yeah.
the loan and the note that you're writing.
we're not,
Yeah.
here's what we're not doing. We're not
Period.
giving them a 100,000. Let's say the house is 100,000, they put 3.5% down, they get a $97,000 loan. And then you add all those fees. There's risk there. We're buying houses at a wholesale price, selling retail. So we're limiting our risk. Then we're selling the first lien to an
Why
investor
we write a
that wants a
70%.
nice, yeah.
This is why we write a 70 to 75% first lien. Okay.
Mhm.
We take the risk by being the note holder in the second, because we're basically saying we trust the borrower to perform. And we're
Mhm.
putting our money where we're saying it, because we're going to stay in the deal. All the money that we're going to make is going to be in the form of a second lien. The first lien guy is protect. Here's a question. Let me ask a question. Okay. I know what my answer is. Would you rather purchase a note, say a 70,000, let's use $100,000 example, okay? Well, let's use 200,000 ratios because that's more realistic. A $200,000 house, we write a $150,000 lien on it, first lien, okay? And we sell it to a note, and you're the note buyer, and you buy that $150,000 9.5% mortgage, and let's say you buy it for $140,000, okay? And and in that situation, the borrower has a 520 credit score and has been late on payments, okay?
Has been?
Has been late on maybe a credit card payment or a car
Okay.
payment or whatever, okay? That's option one. Or you have the ability to buy a 750 credit score W-2 employee that works at Frito-Lay, and it's the same $200,000 house. They put 3% down and they finance $190,000, okay? And you get to buy that note for $185,000, $200,000 house. So do you want to buy the note at $145,000 with a 520 credit score borrower, or do you want to buy the note for $185,000 with a 750 credit score borrower that's got a pretty job and
No-brainer. You would obviously want
so
to
why
buy
is it a
number one.
no-brainer? Why is it a no-brainer?
Well, because the risk is in a different place.
Yeah, it's a huge different place.
Yep.
Because
Mhm.
guess what? The golden handcuffs on a note is the property.
Mhm.
Because let's
Yeah.
just say that you have the borrower defaults, okay? And you can't modify, you can't do whatever, okay? And it goes into the default status and it goes down the foreclosure road, okay? We gotta take that into consideration when we're doing it, because that's what a note buyer is gonna do, right? We take that into consideration. The house is worth $200,000. Let's make that assessment. That assessment. Do you think you got a better chance of a house being worth $200,000 going to foreclosure, getting your money back, if you're only owed 145
Right.
that you put out, or 185?
Absolutely. 145.
Yeah.
Yep.
Because isn't that why? Is that,
No,
isn't that what
we're
trying to do?
technically asset-based lenders, but we're going through but we're selling typically to owner occupant borrowers that want that deserve and can show the ability to pay and be
Here's a news flash, okay? When foreclosures went through the roof in 2008, guess who those borrowers were that defaulted? They weren't the 520s.
They were everyone.
Everybody. It doesn't discriminate,
matter.
right? It doesn't matter.
Mhm.
Yep.
Mhm.
So I want to use the asset as my balance and and my reference point. The borrower is important. Don't get me wrong, because a lot of note buyers are going to look at the borrower. But I would say this, my opinion, note buyers are looking at the borrower as a reason to ask for a deeper discount. My opinion, smart ones, my opinion. Okay. I'm just me, because I look at stuff and that's exactly what I would do. And that's why I do it. That's why I want to know what the asset looks like. That's why I think it's important to know what the value is. That's why we say now, when property values have stopped going up and they're remaining flat or potentially go down,
Plummet,
or
yeah.
2%. Okay. I want to get a third party vetted opinion on true value. I don't want somebody coming in and saying, oh, well, I think it's only worth 180. I go, well, that's great.
Well,
I just had a licensed appraiser.
Yeah.
I just had a licensed appraiser that went to school that understands how to appraise. Tell me the house is worth 190. So what makes you more knowledgeable than the appraiser?
But it also makes your note more valuable when you have viable valuation.
Exactly. That's why we do it, right?
I mean, we have people sending me deals or sending me comps from May. I'm like, we're not
happening.
No, we're 30 days out. But
yeah.
Kate,
did you have another question, or was that the we get them both?
No, you guys are doing great. That's right. Exactly my point. So that was perfect.
Well, good.
Did you have another question for me, Eric?
I don't. I'm going to reach out to you later regarding your bookkeeping services, and it could be a resource for our community as well as
Absolutely.
your clients as well. So that's awesome.
Yeah,
Awesome.
thank you.
All right,
Thank you.
see you later.
All right, what else we got here? What other questions?
Let's see. So Joe has a question regarding estimating ARV in the area where prices are declining right now, and how are we handling it? I think Nick, you nailed it. Was on our acquisitions we are
Yeah. So let me see if I can share this. So it's easier to show it in a model. Let me see if I can. Why don't you go to another question? Let me see if I can pull up the model real quick and show something on the forecasting side.
So Vince asked, how has inflation changed your cost of capital? How has that changed? How has the change affected your note buying criteria? So just keep in mind, our notes are being purchased between 70 and 75%, depending. It's closer to 72 now. Okay. And then we're creating, when we purchase the first lien.
Did he say, I'm sorry, I was looking this up. Did he say the cost of the cost of capital going up?
How has the change affected your note buying criteria? Well, let me read it again. How has inflation changed your cost of capital? Well, it really hasn't.
In what way? What cost of capital to buy, or I don't understand the
I mean,
question.
I can ask him to come on here. Let me see if he's still on here. Let me find him. Vince.
Raise your hand. If you ask that question, raise your hand, because we got a lot of people.
there
And
you
you
go.
go to the front of the, you go to the
Vince,
front.
are you able to be on camera or?
I'm here, yeah.
Okay, yeah. So what's the question you had again? How
I'm just wondering with increases in interest rates, how that's affected everything you do, basically, in terms of
Well,
note.
it makes our job so much easier. Interest rates cannot go too high in our world, okay, from our business. I'm not saying we don't want them to go, because there's a lot of repercussions to higher interest rates, affordability and things like that. But like I said earlier, we were writing 10% mortgages, when Bank of America was at 2.5%. Now the banks have come up closer to what we are. Interest rates don't affect our side of the business as much as people think it does, because let's talk about the end first. Okay. What are we trying to do here? We're trying to create notes. Why are we trying to create notes? We're creating 2 notes so we can sell the first, get our capital back, so we can do something else with it and stay in the deal. So now to sell the first note, we have to have a note buyer, right? Well, we're note buyers. Some of these people on the call are note buyers.
we buy them, we keep them, and we have other.
But let's think of this for a
groups that have
second.
'em.
Okay. What are the main things a note buyer looks for? The first thing that most note buyers, like I said, right, wrong, or different, is the yield, the return. Okay. Well, the return has nothing to do with interest rates, right? A return is relative to other opportunities you have to get a return on your investment, right? ROI, return on investment. So what are you comparing it to right now? You're comparing it to the stock market. Well, okay, well, how's that working out? Okay. You're looking at investing money.
I think where Nick's going with this is our capital loves a freaking hand delivered a coupon at 70 cents on the dollar at 10% interest, and they'll just collect and keep collecting. Every time they get a payment, the risk goes down every time. So the
note side of it, the interest rates don't affect as much as people think.
Okay.
What we're charging. Okay.
Right now, our capital is fine with the returns that we're providing. That could change tomorrow, but right now it's fine.
And on the buy side, it doesn't matter. You could charge me 20% for the money. Because if you run the model at 20%, you're only in it for 30 to 60 days. How much does that really?
Our note buying criteria based off the risk that we're providing with our notes that we create is not a challenge right now. Does that answer your question?
Yes.
Cool. Okay.
Yeah. It's actually easier for us to sell notes now than it was a year ago, because what was happening a year ago? The economy was freaking awesome. You couldn't hardly fall down and not make a crap ton of money in the stock market, right? Guess what? When you have a note, it's stable. It performs.
The note
It's a
buyers
safe
that
return.
the note investment groups that we're with, and it's all about preservation of capital and monthly income. So when
Yeah.
you run the amortization schedule and you figure out what that looks like, it'll answer a lot of your questions. That's
And
a
when we
big-
write high quality paper,
Yep.
it goes, the cream rises to the top. And when buyers can buy something that's better than something else, is usually what sells first. Either
Yeah.
you want the low stuff or you want the high stuff. We choose to be in the high stuff. All right, I'm gonna share this. I'm gonna share
Hey,
the screen.
While you're doing that, so Alex had a question. Is there a high limit to the size of the note you are prepared to buy if it ticks all the underwriting boxes? So I'll give you an answer to that, which is when you create a note and it's at the, like I said, if it's 70% and 10%, and there's a discount there at 90% of that, and it fits the affordability factor for our borrower. So if it's $1 million, let's use $1 million versus $100,000. The $1 million loan at 10% interest, I feel like has a lot, depending on the borrower's ability to pay, and it fits the yield that we're looking for, then fine. But what we mainly focus on, which I feel like there's going to be a higher niche right now for the opportunity for the 450,000 and above, because there's going to be a lot of people that want homeownership that can afford that. But what I'm trying to say is it's got to fit the yields that we're looking for and the risk in regards to loan to value, investment to value. So if it checks all the boxes, yes, but it's based off risk, what the value of the property is versus the loan, which is investment to value, and the return. Does that make sense? So that's how you just got to plug it in, and if it fits, then you got a deal. All right, go ahead. Sorry.
I'm trying to, for some reason, it's not
No.
allowing the share. It's not pulling up the share. I don't know why. We might not be able to do this. If not, I'll just go through it verbally. I'm not sure what's.
You can't share your screen.
No, it's giving me an error. It says
Also there's I know there's people popping on kind of in and out late, whatever. We'll send out replays for this. We always do. Our calls are weekly. They're actually going to be a little bit shorter in the future as we transition and go into more of our other continuity model, group coaching model, as well as replays are in the Facebook group. So you have like two to three ways to get access to the information that we're saying. So
all right. Well, I think I was just going to show one thing on why we do why the ratios are where they are, but we already talked about it, but I was just going to just show it on the spreadsheet.
investment, yeah. Okay.
Yeah. All right, cool. Any other questions, and we'll wrap this up.
Yeah, no, I think we're
Everybody
good.
get answers?
Guys, please, if you have the opportunity and you haven't purchased a digital product, go do it. Go do it now, because things are changing. We've got over 5,000 people in our community. Nick and I are going to make some changes to get a little more in depth on what we're doing, to get people doing more deals so we can hit our goal, which is 1,000 homeowners with homeownership. We want you guys to be part of that community and do it. And if you guys have any questions, last thing, if you have any questions, please put them in the Facebook group, because we gather all that information from the Facebook group and then we answer them in the community. So obviously the one-to-many, we want everyone, when we answer one question, we want, we had 40, 60 some people on this call today, as well as in the Facebook group. So if we answer one, we'll probably answer a lot of questions that you have in your head that you're not thinking of. So anyway, that's it. You guys have a wonderful, wonderful rest of the week, and we'll be sending out the replay, as well as when our next call is going to be, which is typically, I think we're going to be moving it to Wednesdays, but we're just making some changes with our what we're doing. So we'll keep doing our weekly calls. You guys are awesome.
Next week.
Yeah, we'll see you guys next week, and have an awesome day. See ya.
All right, guys, be good. Thank you.
Bye.